Great, thank you everybody for joining the second session, which is the federal tax update. I understand you're all invigorated after the first keynote speaker, and I'm sorry to say that I will be following the speaker. So not great to be following such a great speaker like that. Anyway, so we're going to talk now about the federal tax update. A lot of developments have occurred throughout the year, and I thought I'd start with some fun little facts. Of some information from the IRS. They publish a data book every year, and this is the most recent one that came out. And you talk about here on this first slide, satisfaction with interactions with the IRS. You know, most people are somewhat satisfied, 30% are very satisfied. Now you see 10% are not very, 6 are not at all satisfied, and 5 don't have any opinion. I guess they didn't reach out to the IRS for any reason. Next one I thought was a fun little slide about an acceptable amount to cheat on the taxes. Most people think it's not acceptable at all to cheat on taxes, but it's funny if you see 8% think it's okay to cheat a little bit here and there. So I guess that's it says something about taxpayers, and 3% say as much as possible. I guess they weren't worried. They were satisfied this was an anonymous survey, and 1% have no opinion, probably because they were concerned it was not an anonymous survey. So interesting statistics. The next one, this slide talks about, again, gross collections by type of tax. And you can see the totals, that black line on top, all the way to the right for 2020. You can see it's over about $3.5 trillion. What's interesting about this slide, I think, especially when you talk about tax reform, which we're going to talk about in a few moments, is to see the relative amount of funds raised through one, is the green line is individual and estate income taxes. So this is the income tax revenue generation. The second line is loosely the employment taxes, the purple line, and that orange line on the bottom is business income taxes. So a lot of times you hear about corporate tax reform, and I think just wanted to put it in perspective, and I know the numbers are not easy to tell here, but the income tax, the individual income tax, raises about 6 times as much money for the government as does the corporate or business income tax, corporate and partnership, not partnership, but corporate income tax. And so when you talk about tax reform, they really do need to raise taxes on individuals if they're going to make a meaningful difference in revenue estimates. So I think that, and also employment taxes are about 4 times as large as the business income taxes. So I just want to put that in perspective when you see why it is they need to tax individuals, and taxing businesses really is not going to cut it because it's such a small amount of the total amount of taxes collected. This is an interesting slide too. It just shows the number of tax returns that were filed. So if you look at 2020, start with that third line. I put these arrows here. The third one down, there's 157 million individual tax returns. The 1040s are filed. When you go up to business returns, C Corps is 1.8 million, and S Corps 5 million, and 4.4 million partnership returns. And then on the bottom there, you see there's 28 million employment tax forms filed. And that's consistent with what we saw on the prior slide, where most of the lion's share of this is individual income tax return, 157 million, and there's significantly less corporate tax returns. But the employment tax returns are still a multiple of the business tax return. So somewhat consistent picture being painted here. And I think this is the last slide from the data book. This shows that how exams, tax returns examined by the IRS has dropped dramatically over the last 10 years. So 2011, you see all the way to the left, the blue line represents correspondence exams, which are letters the IRS writes to people. And that green line on the bottom, if you call that green, I guess, talks about, those are field exams where an IRS agent is speaking to a taxpayer and examining the books and records. So you have about 1.7 million returns were examined in 2011. That drops to about 500,000. So it drops significantly by about 2/3. And you see audit rates are way down. So when they talk about the need for IRS enforcement activity, this is the kind of statistic that's generating that call from legislators to increase funding to the IRS, because it is a proven fact that when they increase funding to the IRS, the money comes back, in the enforcement side anyway, the money comes back in multiples, because that's what the agents can raise through audits. We have another slide here, my favorite. Most important thing on people's mind, that first one is, where's my refund? And so it's funny, there's a lot of things here, so questions. But that is the most important topic. People want to know when they can get their money. Okay, so we're going to start talking about tax reform now, and then we'll move on to some specific issues that came up during the course of the year that I thought would be of interest to the group. The first is, so round one of tax reform, what I call round one, is on September 13th. This is probably around 1.1 because the president put forth a lot of proposals on the campaign, and when he came into office, there was a green book he published, among other things. But we'll start back a few months back into the most recent version of tax reform. The House Ways and Means Committee issued detailed proposals on September 13th. And these are the ones that caused a lot of ire in the public: increasing individual and corporate tax rates, increasing long-term capital gain and qualified dividend income rates, and making it retroactive to September 13th. Elimination of that 75 and 100% qualified small business stock exclusion rates for those making over $400,000 a year. This is something that came out of the blue and really was a surprise to many people. This was part of a comprehensive proposal. There were corporate tax increases in this. There were provisions dealing with trusts and estates and step up on basis, all that kind of stuff. And so, well, not step up, they removed step up, but there were many things in this. You see, it's 881 pages of legislative text. But then we heard a lot in the press, obviously, about Senator Manchin and Sinema. Manchin's from West Virginia, and Kyrsten Sinema is from Arizona. And so they were concerned about many things. In particular, Sinema was concerned about the rate increases. She wouldn't agree to any individual corporate tax rate increases. So there were changes. And so on October 28th, Biden issued a new legislative framework. This came in the form of a White House press release. This is a chart that I cut and pasted from that press release, where they eliminated almost all of the individual and corporate tax increases except for the surcharge. So this is a skinny down proposal. If you look here, there's a 15% corporate minimum tax on large corporations with $1 billion of book income or more. There's a stock buyback tax, which applies to publicly traded companies that buy their stock back in the public markets. International tax reform to prevent people from moving jobs overseas. This adjusted gross income surcharge on the top 0.02%. This is a proposal which creates two new brackets: a new bracket for people making more than $10 million a year was an additional 5%, and those making more than $25 million a year, an additional 3%. So 8% total for the highest bracket, people making over $25 million a year. And then IRS investments, the enforcement budget, increasing IRS budget, and finally prescription drug, repeal the rebate rule so they can negotiate better prescription drug prices. And you see it has a $2 trillion tag of revenue being raised through these proposals. That's around where the current proposal is. So then you see that was on the 28th. On the 29th, the House Rules Committee issued a new proposal, about double the size of the prior one, where they removed most of the tax increases from that prior proposal and made this more consistent with the White House proposal we just saw on President Biden's on that press release on that chart. No rate increases, no carried interest reform, no qualified small business stock reform, no retirement or grantor trust provisions, no changes to qualified business income. Really removed most of the tax increases. There were some proposals that I didn't put on here because they really went nowhere. That mark-to-market provision for billionaires, they were going to make them mark-to-market their tradable assets at the end of the year. It was intended to attack 200 billionaires. It's debatable whether the provision is even constitutional, but that went nowhere. Also, financial reporting on account flows. Banks, there was a proposal had to report to any account with movement of more than $10,000 through it would be reported to the IRS. Then it was reduced to $600. There's a lot of they took a lot of grief over this one. It wasn't actually as bad as some of the press reports made it out to believe. It's not as if people's names are reported to the IRS. But there was, a privacy concern that many people, legitimate privacy concerns that many people expressed, which is why they got rid of it. And then no state and local tax relief. Again, this is round 2.1, so we're going to see more changes coming. Just want to give you a sense of where we've been over the past 2 months, which is somewhat dizzying, given the amount of changes. But then you see that 15% corporate minimum tax for corporations and the buyback tax. So that's consistent with the White House proposal. Then we get to round three, and on November 3rd, and this is the current state where we are today, not final, but close to final. The House Democrats released, they call it a manager's amendment to the Build Back Better Act. So a revised proposal. It would provide additional funding to the IRS for taxpayer services, but that key number there is the enforcement number, 45 billion. That's the money that's going to used to hire revenue agents and special agents on the criminal side to audit taxpayers. Operations support is back office, is CFO function, IT, et cetera, human resources, and systems modernization, 5 billion. To me, it seems like that should be 30 billion, given that many IRS agents don't even have the ability to email presently. Maybe they have the ability, just not they don't allow them to send emails. So we still end up, when we have a lot of audits, the IRS, we end up faxing a lot of information to them and receiving it that way, which is it's not the way business works in this day and age. So let's talk about some of the provisions that made it into the most current version of the Democratic proposal. Again, this is not final. There still will be a lot of debate about these provisions, and we do expect there to be some version of relief on that state and local tax deduction, that SALT deduction. Recall in 2017, they put that $10,000 limit on state and local taxes, including property taxes and other taxes, property and real estate taxes being the key, and other taxes, income taxes. They put that $10,000 limit in there, and that affected mostly New York, New Jersey, Illinois, and California. They were hardest hit, those four states. They were talking about increasing that cap from 10,000 to 72,500, and they would extend the cap through 2031. Right now, it's supposed to expire in 2025. You love the way every administration passes rules that expire when they want, the other person in the next administration, so they don't have to deal with it. So this is the relief that New Jersey, in particular, the Senator Menendez have been pushing for, and many Congress people from New York. This is in the current version, but the day it came out, Bernie Sanders, senator from Vermont, already came out against these provisions, saying he does not agree to this is a sort of tax relief for the wealthy. So he wants to cap it at people making $400,000 a year. So there is some debate how this will make it into the final proposal, although some version of SALT deduction relief is expected to make it. The new surcharge brackets we talked about for people making more than 10 million, an additional 5% will be tacked on to the highest bracket, which is now 37%. So it will be 42%. And then if you make over 25 million, that 42% goes to 45% starting next year. Oops, sorry. This qualified small business stock, they're talking about eliminating the 75 and 100% exclusion rates, but people who would have received those rates will still be entitled to the 50% exclusion. So instead of excluding $10 million of capital gain, we'll get to exclude $5 million of capital gain. That would be the maximum if you make over 400,000 a year. But the way they calculate that 400,000, it includes the amount of gain from the stock. So practically speaking, most people who are taking advantage of this exclusion will lose the benefit of the 75 and 100% percentages, because when you combine their salary income with the gain from the sale of stock, it's likely to exceed the $400,000 amount. It is retroactive too. This is the main provision that's retroactive in the current proposal, which goes back to the date they announced it. So any sale after September 13th of this year will be subject to the loss of the 75 and 100% exclusion percentages if this is enacted in its present form. And there is a binding contract exception. So if you had a binding contract before the end of the year, but you sell it after, it will exempt that. You can still get the benefit of those higher percentages. They're changing the wash sale rules and the constructive sale rules to add digital assets, notably cryptocurrency, non-functional tokens, NFTs. They're also modifying the wash sale rules to include commodities, which has been a long time exclusion, which is odd that it's odd that it was excluded, but commodities are excluded and currencies are excluded from the wash sale rule. Remember, the wash sale rule says if you sell a stock and then buy it back within 30 days, either before or after the sale, you buy it before or after, the loss is disallowed and added to the basis of the new position that you hold. That's what the wash sale does. The constructive sale rules, section 1259, what that does is it creates a deemed sale if you do engage in certain hedging transactions, like a short sale against the box kind of thing, or you do a forward transaction to sell stock that you own. So they're trying to prevent people from eliminating the risk but not paying tax. So those rules will be broadened to cover cryptocurrency, which is obviously subject to extensive trading these days. I think Bitcoin recently hit 68,000. So a lot of activity in cryptocurrency trading. The next one is this expansion of the net investment income tax to exclude income derived in the ordinary course of a trade or business for individuals making more than 400,000 a year. And when I say this over 400,000 a year, there are different brackets for married, filing jointly, head of household, etc. I just didn't want to clutter up the slides with all of that detail. They're all around 400, 425, 450 is the income. But there are, anytime you see 400, in many cases there are other numerical amounts that are similar for married, filing jointly, etc. They would permanently extend that excess business loss provision, that's 461L. That provision was put in again in 2017 to say the excess business losses, which are deductions in excess of business income for individuals, non-corporate taxpayers. There was a limit of 500,000 for married, 250 for single. And so they're going to permanently disallow this, put a permanent limitation on these losses. It won't expire in 25 as it was expected to. Also, an exclusion of those Pell grants from gross income as education grants for 4 more years. On the retirement side, they brought back a lot of the provisions about Roth IRAs. I recall that Peter Thiel, I think he was a PayPal founder, and then I think he's behind Palantir, that stock, but I'm not certain on that. But anyway, he has a $5 billion Roth IRA tax-free income. One, anyone having $5 billion is a lot of money, but two, to have it in a Roth IRA is unheard of. So they're trying to pass these limits now, contribution limits. So if you have more than 400,000, it limits, you can't put money in if your account balance is hitting 10 million, and it increases required minimum distributions. If you're over that amount, it forces you to take the money out and pay tax. So someone like Peter Thiel, that $5 billion will be reduced dramatically over time. So there's a formula with they speed up those required minimum distributions. They're talking about eliminating backdoor Roth conversions starting next year. This is something that it's a wonderful play, and it's essentially what you do is if you work at a company as a 401k, you contribute the maximum, but then you contribute after-tax money. So you're allowed to put, we'll talk about what the amounts are. I think it's 26,000 about if you're over 50, let's say. And you can go up to 58,000. So you can put after-tax money in for the difference. And then as soon as you put it in, you convert it to a Roth that's part of your 401k. And then if you have a rule, if you have a special provision in the 401k, you can take it out of the Roth and convert it, Roth 401k, and convert it to a Roth IRA held independently of your employers. Then you can invest in whatever you want. But the point is it allows people to get after-tax money into a Roth and skirt those income limitations that they had in there. So they're shutting that down. And they're also going to shut down regular old Roth conversions where you just take your IRA and convert it to a Roth and pay the tax. There's no income limitation on that. I think that came about 10 years ago. They started that. They're going to shut that down again, starting in 2032. Biden will be out of office, and then so when the uproar happens, he won't be the one to deal with it. On the business tax side, we're going to, as you see, there's a 15% corporate alternative minimum tax on adjusted book income of corporations with a 3-year average income over $1 billion. 1% stock buyback excise tax for publicly traded companies. We talked about this. An interesting provision, the next one, that for plaintiffs' attorneys, normally they can't deduct their expenses because as they pay for contingency fee cases. They don't deduct them until the case settles. This provision sort of puts them on a cash basis and says they can deduct their fees as they pay them rather than waiting until the litigation ends. So just simplifying life for plaintiffs' attorneys, and they can deduct their fees sooner. And then a raft of international tax reform proposals. We could easily spend the hour just talking about these, but I just list in concept what they're changing here, so we can talk about some other points. I'll mention too, when you have these slides, these links here in blue, those are all hyperlinks. So if you want to click on them, that will take you to the relevant document. I tried to link as many of these as I could, so if you take the slide deck, you can find the stuff on your own and get the source material. So round four, this is where a couple days ago, 4 days ago, when the House approved the $1 trillion infrastructure bill. This is a bipartisan bill, not the reconciliation bill we just talked about. But this is the one, it's either 1 trillion or 1.2, depending on which news outlet you listen to. That was passed in the Senate on August 10th. The House managed to decouple it from the reconciliation bill. Recall, House progressives wouldn't sign this infrastructure bill until they had a deal on the reconciliation bill. They were able to decouple it. Biden said he will sign this bill. So I think he's expected to sign it this week. A couple of the highlights. One is they're taking away the employee retention credit for the fourth quarter. And this is a very surprising thing for many people because didn't receive much fanfare when it came out. We did write an article about it. If you register for our updates, whenever we write articles, we can push them out to you if you register online for the coronavirus related updates. So they're going to get rid of that except for recovery startup businesses. This is significant because if your business had been reducing your employment tax deposits in anticipation of receiving the fourth quarter employee retention credit, you're going to need to start paying that back because this president said he will sign this bill this week, so it's going to happen. Also, brokers are going to start reporting transactions in cryptocurrencies like Bitcoin and Ether, and so reporting will kick in for returns required to be filed in 2024. So presumably that's transactions in the 2023 tax year. A lot of times these things tend to be pushed back, though, I should mention, just because of the brokers have to get systems in place. But so as of now, anyway, it's scheduled to start in 2024. And this also makes it, highlights of this act, is it makes it more likely that the reconciliation bill will become law in some form. Because again, the progressives wouldn't sign off unless they had a firm commitment that the other legislation would pass. So that's tax reform. Let's shift gears and talk about the employee retention credit. I'll remind people too, if you have questions, please submit them through the portal online, and they will be routed to me, so I'll be able to answer them real time if you have questions, or we can address them at the end if we have time. So the employee retention credit, this came in March 27th as part of the CARES Act. This has been a tremendous refund opportunity for a substantial number of clients of our firm and other firms. There's two essential employee retention credits, the 2020 program and the 21 program. In 2020 there, I shorthanded it on one line. It gives you 50% of the first 10,000 of wages paid for the full year, but only your period of eligibility. And so in 2021, they broadened it to be 70% of the first 10,000 of wages per quarter. So you'll have Q1, 2, and 3 of 21. Remember, fourth quarter will be going away. There's two ways to get into the credit. You have the gross receipts test and the partial suspension of operations test. Gross receipts is an objective test. In 2020, so you need a 50% decline in gross receipts relative to the same quarter in 19. And in 21, you need a more than 20% decline relative to the same quarter in 2019. The key thing about this is they did extend the statute of limitations from 3 to 5 years. So they are anticipating a lot of audit activity around the employee retention credit. So we are advising clients not to, take positions with the expectation that you're likely to be audited. And this is something where we provide a whole documentation package to our clients when we provide the service, because we do expect many people will be audited much more than the usual audit rates given this extension from 3 to 5 years. I was on a panel last week too with a director in the small business self-employed division of the IRS. That's that SBSC division. And she mentioned that the IRS is training its trainers in February, and they're expecting to begin audits of the employee retention credit later in the year, next year, so 2022. Audits will continue probably for at least 5 more years. A lot of times they ask for an extension from taxpayers, or they just assess, so most people will extend under those circumstances. So it's quite possible the audits can go 5, 6, 7 years from today. We talked about that fourth quarter elimination of the ERC. That is almost gone. Once President Biden signs that legislation, it will be gone. Employee retention credit, if you receive a credit, again, we have clients getting millions of dollars in credit. It's a substantial credit opportunity. If you had any kind of major disruption in your business, you should be talking to someone about the employee retention credit. It's a large refund opportunity at this point. It's no longer a reduction of your deposits, it's just a refund opportunity. So you'll get a large check in the mail one day. The amount of the employee retention credit is not taxable per se. It's not included in gross income, but expense disallowance does apply. So you have to reduce the amount of your deductions, either wages or health plan expenses, that gave rise to the ERC, and up to the amount of the employee retention credit. So effectively, it's subject to tax for both 2020 and 21, depending on which program you got. For 2020, they came up with this weird process. If you get the credit, you have to amend your tax return to disallow the expenses. You cannot just include it and reduce the expenses in your 2020 return, which would have made it easier. They did that in the PPP, as we'll see on the next slide. So you do have to go back and amend your 2020 tax return, even if you receive the credit, apply for and receive the credit this year. For 2020, you have to go back and amend your 2020 return. So a bit of a headache, but a manageable process. And certainly worth it for the amount of the credit that you'll be getting. For 2021, you just have to disallow it on the 2021 return. They're obviously not due yet, so you can plan for that this year. It won't be as big a hassle as going back and amending. On the PPP, just a reminder for everyone, there's been a lot of back and forth on this. PPP is totally tax-free. It's not included in income, and expense disallowance does not apply. Unlike with the employee retention credit, that's because of the passed that Consolidated Appropriations Act on December 27th of last year. So there's no longer expense disallowance. They have a safe harbor here for the deductions. You can put it on the 2021 return if you want. So that safe harbor is available, but does not apply to the employee retention credit. So I just want to mention that for people. Okay, so CARES Act payroll tax deferral. Recall, this is the payroll tax deferral where you could defer your taxes and pay it half in the end of 21, half the end of 22. This is not that President Trump's 4-month deferral at the end of last year. That's not what this refers to. This refers to the CARES Act payroll tax deferral. So the question is, when is the deduction taken? And for cash method taxpayers, it's taken in the year when you pay the amounts. So if you pay it back in 21, it's deductible in 21. For accrual method taxpayers, it's slightly more complicated. If anyone's more interested, we can give you a longer explanation. But there's the all events test you have to meet, and there's an economic performance test. But essentially, in this case, it comes down to when the taxes are paid. But there is a way you can accelerate the deduction into 2021, even if you pay it in next year, and you have to pay it by September 15th if you use a recurring item exception, and there's some requirements to do that. But it's helpful if you want to accelerate the deduction next year. You pay it by September 15th next year, but you can deduct it this year in your 2021 tax return. And there is a method to repaying those deferred taxes. So there's a web link here. You just have to keep in mind you have to separate this from your other payments. So it specifically applies to your deferred payroll tax balance. Okay, penalties. This is an interesting one. And the IRS came out with a chief legal advice memorandum in June. Excuse me. And what this says is, if you pay half of it on time by the end of 21, but you fail to pay the other half, say by the end of 22, they're going to assess penalties on the entire amount. So that example on the bottom says, let's say you deferred $100,000 of payroll taxes. You repaid half by the end of this year, but you don't pay the balance at the end of next year. You pay it mid-2023. In that case, the penalty for failure to deposit taxes applies to the entire $100,000, not just the $50,000 you didn't pay timely. It's a surprising outcome, but it has to do with the way the CARES Act was worded. And it says you have to pay the full amount by both due dates, or the penalty applies to the whole thing. So it's just a surprising result for many people. Just so we are encouraging clients to make sure they pay this on time, because the penalties could be fairly extensive given that it applies to the whole thing. Business meals. This is something, if you recall, that normally is a 50% limitation on the deduction for business meals. There's a special 2-year exemption that was passed from the Consolidated Appropriations Act. So you can deduct 100% of business meals for 2021 and 2022, as if we don't have enough complexity in the tax code, right? So this is a helpful one. So we're happy that we have the ability to deduct 100%, but it does increase. It's hard as an advisor to keep track of all these dates when you have so many things are expiring or springing into existence. It's hard to keep it straight in your mind. So they came out with this, the IRS issued a press release to implement this 100% deduction. And so we're just reminding people here that it's only 2 years, expenses paid this year and next year, calendar years. You can take 100% of their food and beverage expenses provided by restaurants if the owner is present when the food, or an employee is present when the food is provided, and it can't be lavish or extravagant, which applies in any expense. A restaurant is a place that sells prepared food or beverages for immediate consumption, and not takeaway stores like the grocery or drugstore or liquor store. Also, it does not apply to eating facilities located on your premises that are used to furnish employee business meals. A case came out here in the Ninth Circuit. Nothing new about this case, more just reminding people about the Section 280E, which denies expenses for businesses that traffic in controlled substances like marijuana. Although marijuana is legal at the state level, I know New Jersey just legalized it the last couple of years ago. It's supposed to be, I think it's going on sale this year in New Jersey on a recreational basis. Many other states have too. So it's going to be more common, but we do want to remind people that unfortunately deductions are disallowed at the federal level because it's the Section 280 Cap E. And so even a medical marijuana retailer, they do not get the deductions. They get cost of goods sold, because but they don't get deductions. That's not considered a deduction. So no other deductions apply. I put a quote here from the court. This is the latest attempt by a retailer to ameliorate the tax consequences Congress, put in effect for people trafficking in controlled substances. So even though it's legal at state law, it's illegal at the federal level. So the taxpayers cannot deduct their expenses. It's important to remember. And this court, along with other courts, have held that it does not. This Section 280E does not violate the 16th Amendment, which provides the power to tax without apportionment. So this section of the code is constitutional. It's valid, and it does apply. So just a reminder, someone's in this business. Frequently asked questions and penalty protection. This is an interesting one. So as part of the CARES Act, we've seen a tremendous amount of guidance come out of the IRS in the form of FAQs, and also notices, but a lot of FAQs on their website. And so previously what they've done was they issue these FAQs and then they modify them at will, but they don't tell you when they modify them. They don't keep track of the date that the changes were made, and they don't. So one day you're looking at it and it's different. It's different from the prior day, and they didn't announce the change. So it was somewhat frustrating and unfair to people who relied on it. So they said that now you can rely on these FAQ. One, you can rely on them to avoid penalties. But two, instead of just putting them on the website undated, they're now going to release fact sheets where they're going to keep track of these things so you can locate older versions and refer to it if necessary. And as long as you fit within the notice at the time you took your position, you can rely on that for penalty protection. So very helpful in that, I think they're recognizing that FAQs are going to be a lot more frequent form of advice from the IRS. It's something they get out quickly, put on their website, and but people need to be able to rely on what they read on the IRS website. I think this is a recognition of that. And so it's enabling people to rely on these FAQs. Also, the FAQ can be used for reasonable cause defense to penalties. So overall, this is a very taxpayer-friendly development. And it was always surprising when we tell people that you can't rely on the FAQs or a notice that the IRS publishes for penalty protection, even though you can rely on it to take the advice. Just if they stick you with penalties, you can't cite to their own guidance. So now you can, at least with the FAQs. The IRS issued a revenue procedure talking about, so you have a question here, on the employee retention credit. Should we wait to amend the 2020 return until we actually receive the check, or can we do it sooner? Good question. So you can amend anytime you want. I would probably wait until you receive the check, given that you didn't do it already, just because they may not give you the full amount of the credit. They may deny some of your expenses. Let's say you claimed $1 million credit, but they only give you $800,000. If you amend today and take away $1 million of expenses, but you end up agreeing they're correct for one reason or another, that it's only 800, you'll have to go back and amend the second time. So we're seeing anywhere from 2 to 8 or 9 months is the time it takes for people to receive their ERC checks. So it probably makes sense to wait at this point to amend. You can prepare it, get it ready to go, and then just hit send when you get the check. Okay, so thank you for that question. Back to health savings accounts, annual contribution limits went up a little bit. This is for people who have high deductible health plans, which are defined below, but essentially went up $50 to 30. If you have a single individual, you can deduct $3,650 for a family, $7,300 instead of $7,200. And also qualified retirement plan amount, separate notice came out. This is the deferral amount. You can defer your income in a 401k plan. It increased from $19,500 to $20,500, up $1,000. The catch-up contribution for people over 50 remained the same. That's $6,500. So if you're 50 or older, you see you can now do $27,000 instead of $26,000. I mentioned before we were talking about that backdoor conversion, that Roth backdoor. I call it that mega backdoor conversion, which sometimes people call it if you Google it on the internet. IRS contribution limits, should be IRA contribution limits, not IRS. 6,000, no change in 1,000 catch up. The Roth income limits went up a little bit. It's now for singles 129,000, 144,000, up slightly. Same for married filing jointly, up slightly from the prior year. So the IRS compliance campaigns. The IRS came out with 3 new campaigns this year. So let me just briefly set the stage on what these are. These started in 2017. They are from the LB&I, which is a large business and international division. Used to be the old LMSB for people who remember, large and mid-size businesses. And so they began in 2017, and this is the IRS's attempt to shift from an entity-based exam to an issue-based exam. So they identify these issues, and then they go spread around to different taxpayers and start auditing these issues, in addition to entity-based exams. But this was an attempt to specialize, and they would use a variety of treatment streams to get at these audits. So issue-based exams, they have soft letters they would issue to people for information, internal trainings, they issue practice units, which are published on the website, outreach to practitioners, and formal guidance that they would issue. So these are ways that, like cryptocurrency was one of the compliance campaigns. So the goal is to improve return selection, identify risk, and make the greatest use of limited resources, right? Laudable goals. So what are the new campaigns this year? Again, there's 55 in total. I think I linked to it. Yeah, that compliance campaigns right there is a link to the website, so you can see all 55 campaigns. One is on asset transactions. We know the M&A market has been heating up dramatically. We've seen a tremendous uptick in activity from our client base. So when there's an asset acquisition, the parties have to report the value of the assets on those forms that are mentioned and attach it to their tax returns. So what they're doing is they're targeting people who fail to file these forms, or that are inconsistent between the buyer and the seller. So if they're reporting different numbers, let's say the seller reports a lower number of gain, the buyer reports a higher number because they want to depreciate a higher asset base. They're going to start identifying these inconsistencies between the buyer and seller. Second one is an issue that's been around, at least 15, 20 years. So foreign entities, a lot of times these are hedge funds or special purpose entities that want to lend into the U.S., but they want to take advantage of the securities trading safe harbor. Because if you're in a lending business, then your income is subject to tax in the U.S. But if you're relying on the securities trading safe harbor, you're not subject to tax in the U.S. But if you are in the lending business, it's effectively connected income. So what a lot of hedge funds do are they only buy securities, which are existing loans that have been out they season them. A related party originates the loan, and the hedge fund buys it 30, 60, 90 days later. Whatever, everyone has their own guidelines on what they think an acceptable amount of time is. And the thought is they're buying a security instead of lending in the United States. The IRS is now targeting this issue and going to start these issue-based exams. Now, the last one is this Puerto Rico Act 22. This is individual investors that relocated to Puerto Rico without complying with the residence or sourcing rules in the IRS Code 937. So they're trying to get people who either don't meet the code or meet it but aren't complying with the source rules. Okay, the next one is a case I thought would be interesting to discuss, at least one case. This is a case of Ms. Gaston, who is a retired Mary Kay National Sales Director. She started 2 businesses, a jewelry business, and an acting business. So 2 businesses. And the jewelry side, she devoted 10 hours a week to this jewelry business, but then Mary Kay found out about it, that large cosmetics company, Mary Kay, with I think those are the ones with the pink cars, right? They used to drive around. They probably still do with those pink cars. Anyway, Mary Kay objected, so she stopped that activity. Not surprisingly, she had a lot of losses. The IRS denied the losses, saying this is a hobby, your activity. It doesn't rise to the level of a trade or business. The second business was an acting business. She said, she was in her late 60s, Ms. Gaston, and she had acted earlier in her career briefly, in her life, sorry. And then she had kids. Her son became an actor and a cinematographer, I think in Japan. And her daughter, they said, was one of the most successful actresses in Hollywood. More on that later. We'll see if anyone knows who that is. If you do, feel free to submit a question with just the answer in the question, see if anyone knows who Miss Gaston's famous daughter is. Anyway, she took acting seriously in her late 60s and said, I want to become an actress. She retained an assistant, right? What any good actress does, first thing you do is hire an assistant. Then she engaged in casting services. It got an agent, a management company, secured professional headshots. It took acting and voice lessons. It's no surprise that even though she spent 40 hours a week on this activity, she had losses, right? With all those fees, you just see an agent, business manager, headshots, advertising, and voice lessons and casting services. She had losses, and she did get 10 film credits and other commercial roles, but she still was not able to make money at this endeavor, and she lost money. So the IRS disallowed the losses in both activities. They said neither one of them, both were hobbies. Neither one was a valid trade or business, so you could deduct your expenses. So the issue in court was whether she engaged in each activity with the predominant, primary, or principal objective of making a profit. So that's the test you have to meet. Your goal has to be to make a profit, not to have fun doing an activity and hope to deduct your hobby expenses. There's a regulation in the hobby loss rules that looks to sort of the time you spend on the activity, the manner in which you conduct it, whether your expertise, whether you took training, did you carry on similar activities, your success in carrying on, your history of income and losses, etc. There are a bunch of rules on what to look for, and so the court stated the law, which is just that you need a reasonable expectation of profit is not required. You don't have to think you have a reasonable expectation of profit. You just have to have a primary purpose of making a profit. So that's a key distinction, right? You can take a flyer and say, I might not make money in this business, but I want to try it. So you don't have to have a reasonable expectation of profit, which is somewhat surprising to people. But you do have to engage in the activity with a primary purpose of making a profit, so as opposed to a hobby, right, to have fun and to pass the time. So she lost in the jewelry business, as we said. That was considered a hobby. It was less than 10 hours a week, and she stopped it shortly thereafter. But the acting business, they said she was in the acting business. They found in her favor, so she was able to deduct the losses against her other income. And so the reason they found in her favor was she belonged to an acting network or union. She took classes to develop her skills, developed industry contacts. She saw multiple auditions and roles. She advertised her services, prepared headshots. And obviously, we talked about that. She retained an agency and an assistant to help her. And she maintained her efforts over a period of time. It wasn't just 6 months or a year. This is a multi-year endeavor, and she had 10 film credits, as is mentioned, and other commercial roles. So she was found to be engaged in a trade or business and able to deduct those expenses. So I just mentioned this case because it's helpful to remember the rules that about when what is the goal in starting a new business. Another question that comes up frequently, which I've talked about in prior webinars, is when does your business begin? When's a business considered to start for purpose of deducting those expenses? That wasn't the case here, but it's an interesting question. So one question remains: who is the famous daughter? Does anybody know? I'm looking at the question. No one submitted an answer, so I'm going to do the big reveal now. The answer is Robin Wright. Right. So she is in the video is not coming across well here. She was the actor, little girl in Forrest Gump, who that famous line, "Run, Forrest, run," which we can all hear in our heads right now as I'm saying it. I'm sure you're laughing and thinking, I wish you could see that picture better. Sorry, it's not coming through. It worked up until a few minutes ago. Anyway, she was in Princess Bride, which I haven't seen, but I heard it's a very good movie, a comedy, and House of Cards, which is that picture on the right, where she was Claire Underwood, the wife of the president. I forget the lead actor's name, but people love the show. I've seen a few episodes, but people rave about the show. It's been over for a good 5-10 years now. But she's the actress they were talking about, the daughter of Miss Gaston. Okay, so we'll move on then to cryptocurrency, digital asset, Bitcoin, Ether, those kinds of things. This year, the IRS issued 1 revenue procedure and 2 chief counsel advice memos. So I thought I'd do a quick review of cryptocurrency, give you sort of the lay of the land very fast in the remaining few minutes we have left. So the first piece of guidance the IRS issued is that notice 2014-21. They said virtual currency is property. It's not a currency. It's property like a pickup truck, right? No different than a pickup truck, playing cards, any item of personal property. General property transactions apply. So if you barter it, you recognize gain as if you sold it. It can be used as currency, but if you use it, you have a sale of property. It's not like currency. You have to first sell it, and then you can use it as currency. So it would trigger a gain if you engage in a barter transaction. They then put FAQs on their website. They expanded the list of FAQs, so there's a dramatic number of FAQs in addition to that notice. Nothing particularly earth-shattering here. They're just applying long-standing tax principles on property transactions to the cryptocurrency world, recognizing that a lot of people weren't paying tax. So they were just saying, these are the rules that apply. Nothing new here, but we want to tell you what they are because we expect you to pay tax on these transactions. Then they issued a revenue ruling 2 years ago dealing with hard forks and airdrops, 2 very esoteric terms, but not hard concepts. So a hard fork is when I can tell you this. I know I understand what it means. I don't have a real world example to give you, but this is where you have a currency, but they change the ledger so you access it. Instead of accessing it to the left, you access it to the right, for example. But this is not taxable because you haven't received anything new. You're just changing the way you go about accessing your cryptocurrency, your virtual currency. So that's not taxable. An airdrop, however, is where they give you something new. It's a distribution of a new cryptocurrency. Because they for some reason they modified an old currency and gave you something new. You have an accession to wealth in that case. So when you acquire dominion and control over that new one, that's when you suffer tax. So you have to pay tax on it. They also, in 2020, so someone tried to get 501c3 status. They denied that. And then that last one on the bottom of the page, this is an interesting one, a virtual currency reward. So apparently people do these micro tasks on a platform and they earn this currency. So they're saying that's income. Even if you're getting $1 or less for each of these micro tasks, virtual currency worth $1 or less, each one of them is taxable income. It's ordinary taxable income, just like it would be if it were cash, if you're paid in cash. So the new guidance that came out, again, 3 pieces we talked about of guidance. One, this is like lending. When people want to sell short, you have to borrow currency, you sell it short, and then you buy it back and replace it. That borrowing transaction is a loan, and if it were a security, Section 1058 would apply if it were a stock, and so it makes it tax-free, that loan. But it doesn't necessarily apply to cryptocurrency because it's debatable whether it's a security. That's one of the ongoing debates in the tax world about cryptocurrency. So the IRS said we're not going to rule on whether they won't issue a PLR on whether that's tax-free. Whether 1058 essentially applies to cryptocurrency lending. Second thing was they said that at CCA, that one in March, they said that receipt of Bitcoin cash as a result of a hard fork is taxable when the taxpayer retains dominion and control. So that's an airdrop essentially, right? So this is just a straightforward application of that revenue ruling we saw from 2019. And the last one is like-kind exchanges. Recall that in the Tax Cuts and Jobs Act in 2017, like-kind exchanges only applied to real estate after in 2018 forward, whereas they applied to a host of other assets, including some personal property prior to then. So before 2018, that the key is, could you do a like-kind exchange of a virtual currency? Like, for example, Bitcoin for Ether, Bitcoin for Litecoin, or Ether for Litecoin. And the IRS says that 1031 like-kind exchanges do not apply. So you cannot do a valid like-kind exchange, even though you can't do one currently because it only applies to real estate. It did not apply to currency prior to 2018. So that's the end of our session. Thank you for joining. I know you have a 5-minute break. then you have the next session. If you have questions, feel free to reach out, and I'll be happy to address them. So thank you.